Hey guys, welcome to my channel. I am Pavan and I'm a trader for a long time now. I've been trading for 6 years. I trade the US futures, especially the commodity futures on the CME exchange and index as well, like mainly S&P and Nasdaq. Okay, so I trade with a prop firm called Topstrip Trader. The link is given in the description below. This particular firm funds traders across the world, and if you have the ability to pass their evaluation combine, which is made of two steps, then you actually get funded. They have different size of accounts. You can choose from three or four types of accounts. Okay, so I've been trading with them for a while now, and apart from that, I also trade options. I am an option seller. I try to trade the intraday on the expiry days while holding positional on the monthly and weekly expiries. Okay, which is something that I've avoided in the past few weeks because of the current market conditions. Okay, and here I'm uploading an entire basics option course for people who are actually about to start trading or wanting to learn options and option selling. So I'll be uploading this course, and this course is just available for everyone to actually learn. Okay, I spent quite some time building this course, so please do go through and subscribe and share. Okay, now let's get to the slides. Options basics. It's for people with skill level from beginners to intermediate. So after finishing this course, you'll be able to understand how options work and how to make money from buying or selling options. So let's get to the first slide. The first slide is characteristics of options. All options have an expiration date. They do not exist and cannot be traded after the expiration. That means that they actually come with an expiration date, and you will not be able to add them to your watch list as well after the expiration. So I will explain a little bit about this later, and I guess you should know the basics already, right? Second is all options have a strike price. This is the price at which an option contract holder can convert his contract into shares or stocks. So a strike price is a certain price in the options contract at which you can actually buy or sell shares of that particular instrument at that particular price. It depends on what type of option you are holding, which will actually let you buy shares or sell shares. Third is option contracts come with a predefined lot size or contract size. This, as we know it, is the size of the futures contract as well as options contract. So each instrument contains a specific amount of shares or quantities that's actually predefined by the exchange and the SEBI. Okay. For example, in Bank Nifty, the current lot size is 25 quantities. And there are two types of options. One is call option and the other is put option. So call option is when you think the market is going to go up, when you're bullish on the market, and put option is when you actually think that the market is going to go down. Okay. So yeah, and next one is India follows the European option rules and not the American option rules. Okay, there are two types of options again in the world, and one is the American and the other is the European. In the American option rules, you can actually exercise a contract before its expiration, while in the European option rules, you can only exercise the contract during the expiry. Okay, so that's how it works. Now, getting to the call option. A call option price increases and decreases with the change in the underlying stock price. This means that if the stock price increases, the call option also increases. If the stock price decreases, the call option price also decreases. Okay, it's as simple as that. Call option gives the contract holder the ability to buy the shares of that instrument at that indicated strike price. Okay, so simply put, if you actually buy an HDFC 1000 INR strike price call option, you will be able to buy HDFC shares at 1000 rupees per share, no matter what the market price is at that particular moment of time during the expiry. Okay, if the market price is at 1050, then you can buy HDFC shares at 1000 rupees INR. Okay, that's because you have the ability to buy it because of the call option that you're holding at 1000 strike price. Okay, so when the price of the stock continues to increase higher than the strike price, the value of the option increases. So if the price of the stock continues beyond the strike price, okay, the value of the option increases exponentially along with the market price of that particular instrument. All right, let's say that I want to buy this house. The current value of this house is 50 lakhs INR. Okay, and I believe that in the next 2 years the value of this house is going to be 1 crore INR. Okay, so now I'm interested in buying this house with the idea that the value will increase. But for whatever reason, I do not want to invest a full 50 lakhs into this immediately. Okay. So in that case, what I do is instead of buying the house, I buy something called a call option with a strike price of 50 lakhs. Okay. This contract gives me the ability to buy the house after 2 years at 50 lakhs INR, no matter what the market price is at. Okay, so that is the ability that I get, and that is actually much better than investing 50 lakhs immediately, right? But any transaction in the financial market comes with a risk. That risk here comes in the form of paying the premium for this call option contract. Okay, we always pay a premium for any options contract to buy it. Okay, and that premium depends on the option price at that moment. Okay, so for 50 lakhs INR strike price call option, which is going to expire in 2 years, let's say that the premium is 50,000 INR. Okay, so now I'm paying 50,000 rupees for a call option contract which is having a strike price of 50 lakhs INR, which is going to expire in 2 years. Okay, now let's calculate what the total cost of my transaction is. Okay, so the value of the house is 50 lakhs and future value in the year 2022 it's 1 crore. Okay, strike price is 50 lakhs INR and 50 lakh call option value is 50,000 rupees. Okay, expiration date is 2022 June 1st. Okay, I'm just keeping a random date. Okay, now I own a call option contract with a strike price of 50 lakhs INR and an expiration date of 2022 June 1st. Okay, value of the house in 2022 is 1 crore, 100% increase in value. I can now exercise this option contract and buy the house by paying 50 lakhs INR. Okay, so the total cost of my transaction will be the 50 lakhs INR for the house plus 50k, 50,000 that is, I paid for the premium. So that is 50 lakh 50,000 INR is the total cost of this transaction, and I could buy this house 2 years into the future, even when even when the current market price in the future is 1 crore INR. Okay, now if I decide to sell this house immediately right after I buy, I actually get a market value of 1 crore for this house. So my profit is the current value minus my total cost, and that will come to 49 lakhs 50,000 INR. Okay, so this is my profit that I actually got by just investing 50,000 INR initially into this transaction. Okay, so this is a call option contract. This is how we can exercise a call option contract. Okay, now let's calculate the downward risk that I have, because every transaction in the financial market also carries a lot of downward risk. Okay, now let's consider that this house is uh, the current market value of this house is 50 lakhs INR, and in future, instead of the value increasing, the value decreased by 20%. Okay, so the current value in the future, that is 2022, is 40 lakhs INR. Now I'm holding a call option with a strike price of 50 lakhs INR, and I paid a premium of 50,000 for this. Okay, so my total transaction cost is 50 lakh 50,000 INR. Okay, now coming to the call option, I own a call option with a strike price of 50 lakhs an hour and an expiration date of 2022 June 1st. Okay, value of the house in 2022 is 40 lakhs an hour, 20% decrease in the value. Since the market value is cheaper than my strike price, okay, I have the option to not exercise this contract and rather let the contract expire without exercising it. That is why the contracts are called options, because we get an option to not exercise the contract as well. Okay, so I don't have to buy the house at 50 lakhs an hour. Okay, I just let the contract expire, and what I lose is just the premium that I paid, and that is 50,000 an hour. Okay, so let's say that instead of buying call option, I had bought the house, then my total loss would have been 50 lakhs minus 40 lakhs if I had sold the house, and that would be 10 lakhs. Okay, so I would have got 20% less from the value that I paid for the house in 2022 if the value had decreased. Okay, so instead of that, I actually shielded myself from this loss by just buying the call option contract of strike price 50 lakhs an hour. Okay, so this is how options help us from losing, or from the market fluctuations, or from losing in the market by reducing our risk. Okay, so now let's come to a real-time example. Okay, so any option list is called its option chain. Okay, so this is HDFC option chain. On the left there is call option, and on the right there's put option. Okay, let's come to say 1080 strike price. Okay, 1080 strike price option contract is trading at 38 INR. Okay, so again, call option for 1080 strike price is trading at 38 INR. Okay, so when I buy this call option at 38 INR, I get the option to buy 550 shares of HDFC Bank at 1080 rupees. Okay, at the time of expiry, no matter what the market price is at. Okay, so 550 shares is the predefined lot size, and I get the option to buy 550 shares at 1080 at the time of expiry. Okay, now the current market price of HDFC Bank is 1073.95. Okay, as we chose the 1080 option strike price, the option price is at 38 rupees and the strike price is 1080. Okay, option value is going to be 38 into number of quantities in the contract, and that's around 20,900 is the premium that we are paying to actually buy this contract. Okay, so to buy this HDFC call option contract, we are paying 20,900 INR. Okay, so that's the premium that we are paying upfront, and if the HDFC market price stays below 1080, then this contract will be in vain, as we don't have to buy the HDFC shares at 1080. Understood, right? So let's go to the next slide. Okay, so today the market price is at 1073.95. Okay, let's say by the time of expiry, the HDFC price will go up, the HDFC Bank will go up. Okay, so I have bought a 1080 strike price call option, and I can buy 50 shares of HDFC Bank at strike price 1080 per share using my call option. Okay, now by the time of expiry, let's say that HDFC went up to 1250. Okay, so at the time of expiry, using my call option, instead of paying 1250 for the HDFC Bank shares, I use my call option, exercise my call option, and buy the shares at 1080. Okay, instead of paying 1250 for the shares. So totally I get the capacity to buy 550 shares at 1080 instead of 1250. That's around 5,94,000. Okay, and now After exercising this call option, I decide to sell my 550 shares at 1250 INR. Okay, so now I make a transaction of 6 lakhs 87,500 which I receive into my account. Initially, for buying the HDFC Bank shares using my call option, I spent 5,94,000, and by selling the HDFC Bank shares at 1250, the current market price, I received 6,87,500 INR. Okay, now let's calculate the profit I got from this. Okay, so the the amount I received into my account is 6,87,500 minus the amount I paid to actually buy 550 shares using my call option. That's 5,94,000. 5,94,000. Okay. Now the amount I received minus the cost I paid, I get 93,500. Let's not forget the amount that I paid for the call option initially to actually buy this contract, buy the call contract. Okay, with strike price 1080, and that's 20,900. So if we minus 93,000 minus 20,900, we get 72,600. Okay, so that's about 2-3 times the investment or the initial transaction cost for the call option. Okay, so that's around 300% increase in my returns. Okay, so that's the kind of returns that options can give if you know how to exercise them right. Okay, but for the most part of it, we never exercise options. As we go on, you will understand why. Okay, so major advantage of trading option. Okay, when you trade options, you will almost never exercise them. Okay, you do not have to exercise an option to realize the profits. An options value comes from its ability to trade shares of a certain stock price at the strike price as opposed to the current stock price. Okay, so I think the third point is very clear. The options value comes from its ability to trade, the being able to buy a certain stock at the strike price rather than the current market price if the current market price is higher than the strike price. Okay, yeah, so that's about it. And second point, you don't have to exercise the options to realize the profit. Instead, you can sell the options itself to actually realize the profit. Okay, and when you trade options, you will almost never exercise them unless for some reason you couldn't close your trade, and the instrument is in the money when it reaches expiry. Okay, so yeah, that's about call option. Now, option pricing law. Okay, this is an important aspect of options. Okay, so what you need to understand about option pricing law is an options price will always include the benefit or profit that it can provide the owner if the option was exercised. Okay, so now if we go back to HDFC Bank example, uh, we realized a profit of 73,000 change. Okay, by selling the options, sorry, by selling the shares which was bought from exercising the options. Okay, but by the end of expiry, if we are receiving a profit of around 73,000 on the HDFC Bank shares by exercising the call option and then selling the shares that we bought from the call option. Okay, then the option price also will be such that the option price will include this 73,900 or 73,000 change as the premium. So the initial amount that we paid, which is around 20,900 INR as the premium, will have increased to 93,000 change to give you a profit of 73,000 INR. Okay, so let me just go further, you'll understand. Okay, so let's say that HDFC strike price is 1080 INR and the HDFC current price is 1250. Okay, I can use a call option to make a profit of 170 INR per share. Hence, the call option must be worth 170 INR or have a total premium of 72,600 INR to give me a profit of 170 INR per share. Okay, you understood that, right? So 1080 is the strike price, but the current market price is 1250. Okay, so if we minus 180 from 1250, we receive 170. I mean, the result is 170. Okay, so the call option must be at least worth 170 to actually give me that profit. Okay, because the share price has changed from 1080 to 1250, the option price also has to increase 170 points to actually give me 170 rupees per share. Okay, so that's how it works. Going to the live example. Okay, if you notice, you sometimes get a greater value from option contracts than what you would have received by exercising the option and selling the shares. Okay, so let's say that we are choosing 1040 here. Okay, with the strike price 1040. The current market price is 1073.95. Okay, so by exercising this call option, you get a difference of 33.95. So that means we can actually make 33.95 on a single share of HDFC Bank by exercising this. But the option value is 60 INR. Okay, so we are almost getting the double of the value that we will get by instead by exercising it. Okay, so the same goes to uh, the higher call option here. Okay, let's say that I choose a strike price of 940 and the current market price is 1073.95. Okay, so if we minus both, we get 133.95. All right, so if you exercise this call option, we make about 133.95 per share, but the option value is 141.95. That means that I'm receiving about 7 rupees more per share than how much I would have received by exercising this call option. All right, so you got that, right? So in the above example, when we exercised the option and sold the shares, we made about 72,000 INR on a transaction of 20,900 plus 5,94,000. That's around 6,14,400. Okay, the profit accounts to about 11% of the capital involved. Okay, so yeah, this is the chart that we saw. Okay, but instead of exercising the option call option, if we had sold our contract at the option price just before the expiry, which theoretically should include the profit if it gives by exercising it, which is 1250 minus 1080, that's around 170 rupees, we receive 93,500 INR, which had an initial investment of 20,900, which is about 400% returns on the investment amount. Okay, so this clears the doubt, I guess. That is, the option value must be worth the difference in the strike price and the current market price. Okay, so the option value should at least be worth that much by the time of expiry. All right, now what we learned so far: a call option is one of the types of option. Okay, a call option gives the buyer the ability to buy a lot of stock at the call strike price. Okay, so you can buy any instrument. You can buy the contract of call option contract of that instrument at a particular strike price, and that contract will give you the ability to buy that instrument at that particular strike price with the predefined lot size, which is the quantity that is predefined by the exchange and SEBI. Okay, a call option becomes more valuable as the share price increases and as the ability to buy the shares at the strike price can produce greater profits. Okay, so the value of the call option comes from its ability to buy at a cheaper at a discounted price than the actual market price. Okay, and you don't have to exercise the option to realize the profits. Call's price will include any profit you could make by exercising it. To realize it, simply sell the call option. Okay, so you don't have to exercise the call option, buy the shares and sell the shares. Instead, just sell the call option. You will get the value that you can actually get from the difference between the strike price and the current market price. Okay, losing money in buying call option. Okay, if you buy a call option and the share price decreases, so will the value of the call option. If the stock price is below the call's strike price at the expiration, the call option will expire worthless and you will lose the entire premium paid for it. In case of HDFC Bank, we paid 20,000 INR for 1080 strike price call option, and if the HDFC Bank stays below 1080, the premium that we paid for that particular contract will go down to zero, and you will not be exercising it as well, because why do you want to exercise it and buy the shares at a higher price when you are actually, when the current market price itself is discounted from the strike price, right? Okay, so that's call option. Now let's go to put option. Okay, so the put option, a put option is the second type of option contract, and this comes with a bearish view of the market. Okay, a put option gives the contract holder the ability to sell the shares at the put option strike price, just like how call option gives the ability for the buyer to actually for the holder to buy shares at that particular strike price. Put option gives the buyer of that option the ability to sell the shares at that strike price. Okay, a put option price increases as the strike price as the stock falls. Okay, so yeah, it's of bearish view. So if the stock prices fall, then the put option price also increases. Okay, as the stock price continues to fall, the contract becomes extremely valuable, just like how call option prices become valuable as the prices go up. Okay, so now coming to HDFC Bank option chain, we are going to use the same snapshot. Okay, so that there's no confusion. Now let's consider the 1070 strike price. Okay, and it's trading at 37.1. Okay, so considering this, the current market price is 1073.95. Okay, let's consider it 1074. Okay, now put option strike price is at 1070. Okay, put option price is at 37.1. To buy this put option, we need 37.1 into 550, that's around 20,405 INR premium. Okay, premium required in the account. This gives me the ability to sell the HDFC bank shares at 1070 irrespective of what the stock price on the expiry will be. Okay, so with the call option, we wanted the price to increase for us to make profit. With put options, it's the opposite. We want the price of the share to decrease to make profit. Okay, hence with the above contract, I have the ability to sell HDFC bank shares at 1070 if the stock price goes below 1070 at the time of expiry. Okay, now put option 1070 strike price value is at 37.1. Okay, and let's say that HDFC Bank starts dropping after I bought the put option at 37.1. Okay, so what happens at the expiry is I get the ability to sell HDFC Bank shares at 1070. Okay, even though the market price is at 1050. So that means what I can do to exercise this option is, when I exercise the put option, I can buy 550 shares of HDFC Bank at 10,000, sorry, at 1050, and the put option will actually give me the ability to sell these shares at 1070. Okay, so for a put option, you need to have the shares in your uh, account to sell them at a higher price. Okay, so that is how you exercise the option. And instead of exercising this option, let's say that I sell the option contract. Okay, the put option contract of 1070, then the option contract should be giving me that value which is equivalent to the difference between the strike price and the current market price, which is 1073.95, sorry, which is 1070 and 1050. Okay, so that is around 20 rupees. So add that to the current added to the premium that I already paid, the put option value should be at 57.1. So I can, instead of exercising this contract, I can just sell the contract and make that 20 INR directly from the contract itself. Okay, so that's one way to exercise it. Okay, sorry, that's one way to realize profits from options. Okay, let's move to the next one, options price components. Okay, so this is slightly in depth, but it's easy, it's nothing much to think about. Okay, the first topic is intrinsic value. Okay, in my house example, the call option gave me the ability to buy the house at the strike price. Strike price 50 lakhs INR, market value in the future is 1 crore INR. Since I can buy the house for 50 lakhs less than the actual value at the time of expiry, the call option is said to have an intrinsic value of 50 lakhs. Okay, so basically intrinsic value is nothing but the difference between the strike price and the current market price. Okay, so that's the intrinsic value. And options, where the strike price is, in a call option where the strike price is higher than the current market price, the intrinsic value is actually zero. Okay, they can't be negative, it's actually zero. All right, so now intrinsic value of options. Call option intrinsic value, stock price minus strike price. Okay, so let's consider the current market price of HDFC Bank to be 1250 and I have a 1080 strike price. So the intrinsic value is nothing but 1250 minus 1080, that is 170. Okay, that means that the call option has an intrinsic value of 170 rupees. Okay, put option, it's the opposite. It's the strike price minus the stock price, because strike price is higher than the stock price in put option. Okay, so let's say that I have 1070 strike price put option and the current market price of the HDFC Bank is 1050. So the put option is considered to be having 20 INR intrinsic value. Okay, extrinsic value. Now, intrinsic value is something that comes when the options give you a benefit. Okay, like in call option, it gives you the ability to buy uh, an instrument cheaper from what the current market price is, and the put option gives you the ability to sell that instrument at a higher price from the current market price. Okay, there is something called extrinsic value of the options. Let's get to the example here, that will make it clear. Okay, let's say that, let's consider 1000 strike price of HDFC Bank. Okay, and the call option is 1000 strike price, which is trading at 87 INR. Okay, now the call option can buy HDFC Bank shares at 1000 INR, which is 73.95 lower than the current market price. The option has an intrinsic value of 73.95. Okay, but the call option's value is 87 point INR. Okay, so extrinsic value is nothing but the value of the option which is in excess of the intrinsic value, which is 87.87 rupees minus 73.95, which is the intrinsic value, 13.05. 13.05 is the extrinsic value of this option. All right, so extrinsic value of an option. An option's extrinsic value is the portion of the option's price that exceeds the intrinsic value. Okay, extrinsic value is sometimes called the time value. We can understand an option's extrinsic or time value as part of its price associated with the potential for the option to become more valuable before it reaches expiration. That means if the time for expiration is longer from the day of the option was purchased, then the extrinsic value is higher. Okay, because there is an ability for the option to give you more benefit with time before the expiration. Okay, Option with more time to expiration has significant extrinsic value than the same strike price with less time to expiration. Okay, let me just give you an example. uh, let's consider HDFC Bank 1000 strike price, July expiry and August expiry. The July expiry is trading at 87 while the August expiry is trading at 108.9. So the same strike price call option is trading at two different prices. That's because the August expiry has higher has more time for expiration, and there is a chance that that particular contract will give you more benefit than the July expiry because of the current market conditions or whatever the current speculation is about HDFC Bank. Okay, HDFC Bank July expiry call option. Okay, so now consider that HDFC Bank, consider these two strike price, 1100 and 1110. Okay, so 24.9 and 28.75. Current stock price of HDFC Bank is 1073.95. Okay, the call option contracts with higher strike prices are trading with a premium even though the contract has no intrinsic value. Why would I want the ability to exercise a contract that makes me buy shares at a higher price than the current market price? Okay, so if you understand this, the current market price is 1073.95. That means that the call options of 1100 or 1110 shouldn't be of any use to us because the current market price is cheaper than the strike price. But since uh, this price was taken on July 3rd, okay, there is an entire month for expiry, and within that month anything can happen where the price can actually, where the contract can give you a lot more benefit. So at the moment we know that these option contracts have no intrinsic value because the current market price minus the strike price for options is actually less than zero, so that makes it zero. Okay, so since the entire value is not intrinsic value but it's made of just time value, this option is said to have 100% extrinsic value at the moment. Okay, so with time, with each passing day, if the HDFC Bank share prices remain at the same level, then this time value, this extrinsic value, which is 28.75 and 24.9, keeps decreasing as the the share prices either decrease or stay at the same level. Okay, now HDFC call option time decay. Let's say that I have an August 1000 strike price of HDFC Bank at 108 INR, which is taken from the screenshot, and the total premium is 59,500. Okay, for 550 quantities of HDFC Bank contract. Okay, so with time, as we move close to expiry, there is a decay in the premium, and with time the 59,500 value starts to decrease. Okay, and as it reaches expiry, if the current market price of HDFC Bank remains below 1000 INR, then my call option, which had a premium of 59,500 from 108 rupees INR of the option value, option price I mean, will come down to zero. Okay, now option prices. The three terms that you have to understand: in the money. An option is said to be in the money if it has an intrinsic value. For a call option on HDFC Bank, the current price is 1020, strike price is 1000. The contract is actually in the money because the current market price is higher than the call option. Okay, for a put option, the strike price is 1000 and the current price is 980. 980 is lower than 1000 strike price, so yeah, the put option is in the money. All right, and at the money is almost equal to the current market price and say that the current price of the HDFC bank is 1005 and the strike price is 1000. So the option is currently at the money. Same goes with strike price for the put option as well. Okay, if the strike price is 1000 and the current market price is 992, then the put option is actually at the money. Okay, and out of the money is an option which is far away from the current strike price of the call option or the put option. Let's say that the current price is 960 and strike price is 1000. Okay, so that option is set to be out of the money for call option. And for put option, let's say that the strike price is 1000 and the current market price is 1050, so we are holding an out of the money put option. Okay, now selling options, or also it's also called writing options. Okay, in stocks we can buy shares and sell them at higher price, or we can sell shares and buy them at lower price. Okay, the same applies to options as well. Okay, we buy an option at a lower price and sell them at a higher price. The same way we can actually sell the options and buy them at a lower price. Okay, this buying of option and selling them at higher price, we benefit from the gain in the intrinsic value, while selling options and buying them at a lower price, we gain from the loss of extrinsic value. Okay, so yeah, when you buy an option you pay a premium, but when you sell an option you receive a premium. Okay, so if I short 1000 strike price call option of HDFC bank, which has a lot size of 550 and the option value is at 10 INR, just for the sake of example I am rounding off the number. Okay, sorry, I am quoting the price at a very low price because to make this concept understandable. Okay, so let's say the option value is 10 INR and the strike price is 1000 INR. Okay, I get 10 into 550, that is 550 is the predefined lot size and 10 is the option value, that is 10 into 550 shares, 5500 INR credited to my account if I sell the 1000 strike price call option of HDFC bank. Okay, now I wait for a while and I buy back the HDFC call option to close my trade. Okay, and the buyback value is at 5 rupees INR. Okay, that means in this case I give back 2250 INR from my account to purchase the same option to square off my position. Okay, so initially I received 5500 rupees and I had to give back 2250 to buy this back to square off my position to be net zero. So I made 2250 profit. Okay, my profit comes from the difference between the premium received when selling option and premium paid to buy back the same option. Okay, so that is 550 5500 INR minus 2250 premium paid. Okay, so I saved 2250 premium that I received. Okay, so Nifty option chain. Okay, so let's say that Nifty is trading at 10,750 levels as of July 8th 2020. Okay, and the lot size is 75. Okay, let's pick 11,000 strike price, 27 August expiry. Okay, is this call option in the money or at the money or out of the money? Does it have intrinsic value? The option has 100% extrinsic value or time value. It is out of the money. That is because the current market price of Nifty is 10,750 while we are looking at 11,000 call option. Okay, so when you sell this call option you collect the premium into your account. So the premium is lot size into option value, that's around 75 quantities is the lot size into 260.2, which is the value of the 11,000 strike price call option. Okay, now if you short an option, it is an extremely risky trade to enter, as the option value can gain intrinsic value exponentially with Nifty moving deep in the money. Okay, so deep in the money means that the the current market price increasing beyond uh, the option strike price, in which case if Nifty starts moving to 11,200, 300, or 400 against a strike price of 11,000. Okay, hence to account for these losses that can be incurred by the account, the exchange and the broker would require you to cover the risk in the form of margin. For the above example, where Nifty call option has about 50 days to expiration made of 100% extrinsic value, the margin required is shown here. Okay, so 27th August, 11,000 CE, if you sell this particular option, you need to have an estimated margin of 1,31,000, okay, in your account to sell this particular option. Okay, buying a call option comes from the idea that the stock price will increase in value, thus giving the call option intrinsic value by the time of the expiry. Hence, as the stock price closes towards the strike price, the extrinsic value erodes and the intrinsic value is added when the option moves in the money. Okay, but when you sell a call option, your opinion is of bearish nature on the stock, so you want the stock price to move further away from strike price and stay out of the money and until the expiry. Okay, so estimated margin premium here is 1,31,253 change. Okay, so that's the amount you need in your account to sell this option. Okay, so shorting 11,000 strike price call. Okay, so if you are actually shorting the option at 278.1, let's say that Nifty is 4 weeks away from expiry and the current market price is 10,500. Okay, and so the value of the option decreases, and let's say that Nifty rallied in the next week by 300 points, the value of the option increases. But if you see, the value doesn't gain as much because the time towards to expiry is actually reducing. Okay, so with time, even though the Nifty's value is equal to what the last week's value is, the option value has reduced drastically. That is because the time towards expiry is becoming less and the ability of the option to make this contract go in the money is reducing. Okay, so by the time of expiry, Nifty is at 10,700, and finally the option value has actually come down to say 20 INR just before the expiration. We can buy it back and we make about 258.1 INR per share. Okay, on 550 quantities. All right, so shorting Nifty call option at 278.1 for 75 quantities, we get 20,857.5 into our account. Okay, so buying back the same option on the week of the expiry at 20 INR, cost to buy back is 20 INR into 75. Okay, that's 3,000. So premium, my total profit is premium collected minus cost to buy back. That's 20,857.5 minus 3,000. That's 17,857 is my profit just by selling the options. Okay, so that's shorting Nifty call option. Now shorting Nifty 10,000 strike price put option. Okay, and the short was at 200 INR and Nifty falls to 10,500. Okay, and the put option value increases and Nifty again rallies to say 10,800, the put option value decreases. It falls again to 10,500, the put option value increases, but it doesn't gain as much as it was 4 weeks away from expiry. And Nifty again rallies to 10,800, 1 week away from expiry, and the put option value decreases. And during the week of expiry, Nifty is at 10,700 and our put option is almost worthless because there is absolutely no chance of Nifty coming in the money on the day of expiry or in the week of expiry to give some intrinsic value to this put option. Okay, so in this case I have shorted Nifty at 200 INR of 75 quantities, receiving a premium of 15,000. The cost to buy back is 5 into 75 INR. So out of the 15,000 that I collected in the form of premium, I'm giving back 375 to close my position, thus making a profit of 14,625 on my position. All right, so this is how I made money from shorting the put option. Okay, so just in general, buying a call option is bullish view, buying a put option is bearish view, selling a call option is bearish view, and selling a put option is bullish view. Okay, so coming to the next topic, implied volatility, expected magnitude of price change. Okay, this is the meaning within these two words. Okay, let's say that there are two stocks which is almost of similar value. Okay, and we pick two stocks of similar strike price and compare it. Okay, if you see there, M&M has about 17 rupees, 17.7 INR option price for 600 call option, while Bharti Airtel is 22 rupees for 600 call option. Okay, both these stocks are almost at the same price, trading at the same level at this point of time. Okay, the difference in the price for the 600 call option on both the instruments or both the stocks with the same expiration is because people expect that Bharti Airtel has higher volatility than M&M. Hence, people are ready to pay higher premiums for something which has higher ability to move into the money or higher ability to fluctuate than the stock which doesn't have the ability to fluctuate. Okay, so change in implied volatility with time, current implied volatility, options reflecting IV. Okay, so higher implied volatility, options reflecting the higher implied volatility. Okay, so as the options start fluctuating more, the IV expands. Okay, if a stock becomes more expensive related to the time until expiration, that means the IV has increased. Okay, option sellers benefit from the drop in implied volatility, while option buyers benefit from the increase in implied volatility. Okay, so short option assignment. Okay, this is probably the last topic. Okay, so when you short an option and when an option gets exercised, it's called option assignment. Okay, so you are assigned the underlying instrument. Short option assignment: when an option gets exercised, a trader who is short that option gets assigned, which is called option assignment. Okay, so if a trader is short call option, then a trader who is short call is assigned a negative share portion. That is, if the lot size of that particular stock is 100, then the trader is assigned to have sold 100 shares of that instrument at that particular strike price. Okay, short put trader assignment. Okay, a trader who is short put option is assigned to have a positive share portion. That is, if the lot size of a stock is 100, the trader is assigned to have bought 100 shares. Okay, so revising long options, long call assignment, a trader who is long call option is assigned to have a positive share portion, and a trader who is long put is assigned to have a negative share portion. Okay, important, any option with any intrinsic value gets exercised if left uncovered after the expire. Okay, So you need to close your positions before the expiry if the options move in the money. Otherwise, the options will get exercised and you will be assigned the position. uh, in case of call option it's positive, and in case of put option it's the negative position. So that is why you actually have to square off your position before the expiry. All right, now which stocks for option trading? You have three important aspects to consider. One is volume. You can check the daily volumes on the stock. Whichever has a greater liquidity will have greater options market movement as well, options liquidity as well. So you can consider that. And option and stocks trading with narrow bid and ask spreads. Okay, so narrow bid and ask indirectly points towards higher volume and hence the higher liquidity in the options market. And high open interest, options with highest open interest the uh, considering all the strike prices will have higher liquidity. Okay, so margin requirements: going long on put or call options requires you to have cash equivalent of the premium of that option value in your account. Going short usually requires you to have more than 5 times the actual premium of the contract, because shorting option carries unlimited risk. Okay, but new rules for margin by exchange has made it easier for retail traders to participate in the options market. The margin required can be reduced by hedging a short option portion, by going long or taking a counter position on a different strike price. Okay, that is going long. Okay, example, if you short nifty 10,000 call option, it requires a margin of 1.3 lakhs. You can reduce this margin required by going long on 10,200 call option. Okay, so let's go to the video to show you this. And this is just to show you how the margins actually are affected by hedging. And this video ends the basics of options. Okay, I will be uploading more videos regarding the strategies used for option selling, and both for intraday and positional. Okay, so intraday I usually work with only one kind of option strategy, that is delta hedging. And for longer like monthly expiries or weekly expiries, I try to apply the most basic option strategies. All right, so I will try to explain, I will try to upload more videos regarding options, and please do subscribe. And yeah, let's go to the video now. Okay, let's say that I want to hedge Nifty and reduce my margin. Okay, let me explain you with an example. uh, I'm on Nifty. The current spot price of Nifty is 11,194. Options, I want to sell 27th August expiry 11,500 contract, which is trading at 162 rupees per contract. Okay, I'm selling the call option of 11,500 strike price August expiry. The margin required is 1,24,783. Okay, this is at least 8 to 10 times more than the margin, sorry, more than the contract value if we had bought the call option. Okay, so now I want to reduce this margin required by hedging this portion. Let's say that I actually bought a call option of 11,700 strike price, the same expiry. Okay, so the margin required reduces at least 5 times to 27,871. Okay, so this is because we are hedging and we are protecting ourselves from the directional movement of Nifty. Okay, so we use this strategy to uh, devise our plans for the positional and expiry trades. Okay, for weekly positional and monthly expiry trades. Okay, I will try to upload more strategies in the future. I mainly trade the expiry intraday and rarely positional because of the current market conditions. Okay, so yeah, I trade with, like I mentioned, I trade with a prop firm called Upstox Trader, and futures is my actual bread and butter. Okay, so this prop firm funds anyone who has the ability to actually show that they can actually pass their evaluation. Okay, the the payout is based on profit split, which is 80% to you and 20% to them. So that is actually the best in the industry. Okay, so if you want, you can try. The link is given in this description below. Okay, they have both forex and futures programs, so you can try either. Okay, and if there's anything else, please do comment and leave a feedback, and do share and subscribe. Okay, so that's about it. See you guys soon. Have a great trading week, have a great trading month, and have a great trading year ahead. Okay, so thank you, bye, see you guys.